Hi there. Welcome to our brand new show, Hisaab, Kitaab. With this series, we at Fisdom are getting you closer to the authors of some of your favorite financial books. Join in to listen to unfiltered, candid conversations about investments, financial planning, and the deeper takeaways that each of these books have to offer. On our first episode, we have with us Anupam Gupta, chartered accountant, independent financial consultant, author, and host of the popular Paisa Vaisa podcast. Catch him in conversation with our CEO and co-founder of Fisdom, Subramanya S V, on his latest book, The Wisest Owl, Be Your Own Financial Planner. Now, Indians, especially the youth, have taken to investing in a big way over the past few years. However, this has also given birth to challenges around investing, the way we look at money, and the way we look at our future. Anupam's book offers a framework with which young investors can build long-term wealth. And he does this by banking on the expertise and wisdom of India's top personal finance professionals. Listen in and enjoy.
Hey Anupam, thank you so much and welcome to our show Hisaab Kitaab. Thank you so much for writing this lovely book, The Wisest Owl. Just to introduce the book to our audience, it's a very well written, a short book on financial planning. It's called Wisest Owl and it succinctly offers background of capital markets in India, their evolution, the future opportunity, and how any individual should go about planning their finances. Usually he interviews people on his famous show Paisa Vaisa, but this time I'm interviewing on his book. Anupam, thank you so much for joining us.
Oh man, thank you for having me, Subbu. It's so nice. This is literally the first marketing activity for my book, and I'm really proud, really honored to that you're hosting this for me, because you were also the last guest that I had in the studio way back in, I don't know, man, it looks like 1820, honestly, in the studio pre-pandemic. But thank you for having me.
Thanks, Anupam. Just to begin with, how did the book come about in terms of what is it not? And also, I found the idea of interviewing the RIAs, bringing them to the fore, pretty fascinating. So can you tell us about that?
Yeah, it was a very logical progression from the Victory Project. I finished writing the Victory Project with Saurabh in somewhere around end of 2019. The book was launched in August 2020. And that book also has a similar format. There are 6 principles and there are 6 interviews. I had his own thoughts, and I was pretty clear that I was going to write my own book. The only question was what's going to be the topic. And now we are about in towards the end of 2020, where I thought of all the conversations I've had on Paisa Vaisa for the last, at that point of time, 4 years now, of course, 5 years, and the kind of questions that keep on repeating over and over again. And of course, this was also 2020, 2021, where remember, you had this massive wave of people coming in, demat accounts being opened and mutual fund SIPs and this and that and all. And it was essentially to answer a lot of the repeating questions that happened. Now, here's the thing. I'm not an investment advisor. I'm not an expert, right? And neither am I a fintech startup founder that I will know all of this stuff. So I said, let's just hand it over to the experts and let me do what I like doing, which is right. And it became like a logical thing from Paisa Vaisa, where I'm just the host and you've got the expert. So that was why the book happened. What is it? It's a guide. It's a roadmap. It's a starting point for a lot of people to pick up the financial planning. What is it not? It's definitely not a book for you to figure where to make the next 10 crores or 100 crores. It's not going to give you a detailed plan for fire. It's not going to tell you the best stocks that are out there. So I think that's an answer to your question.
Well, thanks, Anupam. I know, as I said, the book is organized into 6 chapters. The first chapter is where you talk about what you just referred, dramatic explosion in demat accounts, SIP inflows, all of that. And you also talk about the short-term effects of work from home, from pandemic, and also long-term considerations that you talked about why the market is expanding. When someone reads the chapter, it feels like, to put a meta point, it feels like the average risk-taking ability of an Indian has gone up. Seems like it was much lower 10 years ago. Now it's dramatically higher. What do you think? Is it broad-based? Is it shallow? Is it like across age axis, geographic axis? Is it broad-based and also socioeconomic class? How do you see this, Anupam? That's what the chapter kind of makes out.
Yeah, and Saurabh's foreword in the book is just I'm just really honored to have him to start the book. And if you see the way he starts his his foreword, he says that India has always been seeing these kind of changes happen. So for anyone who was in the India of the 80s, for example, and would have seen the post-Dhirubhai, post-Reliance equity cult that was built out there, it was madness. It was madness at another level. That obviously this generation will not know. Fast forward 10 years later, Harshad Mehta, same thing. So if you look at it as a risk aversion or risk appetite question, I don't think there's been any significant change. Obviously, this is a much younger demographic. That's what is different from 80s or 90s, that half our population is below the age of 35. And of course, there's a whole technology thing, So I don't think things have changed. I just think that the attitude towards investments in general, and when you use the word risk, there's probably just one asset class that is a gauge of risk, which is equities. Nobody, goes into real estate. Nobody goes into gold or debt mutual funds with a very high risk, high return kind of a profile. They probably should, but that's a different question. So equities is the only way to gauge that. And the numbers are there for you to see. 11,000 crores per month of SIP money coming in, 1 crore of demat accounts that were opened. As a tech startup founder, you also would have seen that this massive burst that has come in. Yes, that is what is different. Attitude towards risk, I think it's pretty much the same. Everyone, wants lowest risk and highest return, but eventually they find their way through.
No, absolutely. One of the factors I wanted to ask your, feedback on is what has been the role of lower interest rates in this whole movement of money from deposits to, equity assets? Because even 2010, 2012, one could get a 8, 9, 10% fixed deposit, not a savings account, but a fixed deposit would still fetch you 8, 10%. Now it's like 4, 5%. And we have seen, people who are in their 40s and 50s who always thought, investing in stock markets is, I'll come to that chapter, the next chapter, but they're saying, hey, listen, look, I'm earning like 4, 5%. Given the bull markets, I might as well put some money here. You think that also has played a role?
Of course. Low interest rates has played a massive role. I mean, indirectly, if you look at the kind of funding the startups got, that was also kind of a second order, or maybe even first order effect of low interest rates in the US. And when that came in, and you had this massive knowledge base that came up about why you should put into equities, that was indirectly coming in from the low interest regime or era, so to say. And that low interest era is now pretty much over. If you look at it on a slightly broader historical basis, then between 2006 and 2003 and 2008, which was the previous equity bull market, that was also an interest uprate cycle. But That was also a period where mutual funds, saw inflows. It was also a period when stock markets went up. So interest rates will definitely play a role. They play a role of anchoring in the mind. Today, if you see, as it was a couple of days ago, you had a company come out with, I think it was an FD of 12%. Yeah. I haven't seen 12% FD since the 90s, man. I was like, wow, what is this? Now, when you see that, obviously, first shot, you'll think that, equity, so I can't time any which way. So let me look at this. So in India, there's a very strong anchoring effect because you've got a PF, a provident fund, which is a government sovereign guaranteed interest rate, tax-free, which is at whatever it is. I think it's about 7% plus. That's not the case in the US. In the US, you know how it is. I mean, a lot of places, banks ask you for money if you're putting your money with them. So interest rates will always play a role.
Understood. And final question on this topic, particularly given what's happened to some of the IPOs that happened in the last 2-3 years, prices are lower, obviously they're front page story everywhere. Without taking names, you think in the light of that, how sustainable is this sort of momentum that we are seeing in this whole explosion of the market?
So I think good IPOs will always attract attention.
Okay.
It's very rare. I think HDFC Life is the only one IPO that I remember in the last 4-5 years which actually did not get fully subscribed. The hype ups and downs, Subbu, you know that. I mean, and then once the reality sets in, people learn from that hype and then approach the next IPO. Accordingly, in bull markets, high-profile IPOs will always garner a lot of attention, a lot of noise. Over the longer term, all these things even out.
Yeah, got it. Thanks, Anupam. So moving on to the second theme of the second chapter rather, where you talk about the evolution of capital markets. That was fascinating reminder to me because I think many of our viewers, our customers would not know how difficult was it to apply for an IPO 10 years ago, or for that matter, how difficult was it to apply, buy a mutual fund scheme even like 8 years ago. I remember those forms that used to fill in an IPO, etc. It seems like we've come a long way. The interesting that I found was throughout the 90s and early 2000s, there were lots of scams, which you list out in the book. And when I read the book, I was like, wow, man, really? There's so many of them? I don't remember any of them. And suddenly there is so much trust in the capital markets these days. We don't feel like many of those fears that people had, as you talk in the book, where people thought it's all gambling. In general, there seems to be a trust in the system. Again, I'm keen to hear from you in your assessment. What's changed?
Capital market reform, Subbu. I think at some point of time in the 90s, the government woke up and said that you have to draw a line somewhere, because if one broker in the 1992 can account for so much of the stock market and game the system in a certain manner, then obviously something is seriously wrong. And if you look at India's progress on reforms, at least as far as assets and investments goes, it's been very, 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 very progressive. I mean, if you look at fintech startups, you know that India's payment system is now among the best in the world. Now, whether how much of that is by policy design or not, I think post 91, we've just made a lot of progress on the capital markets reform. A lot of it was low-hanging fruit. A lot of it was a lot of hard work that was done by the regulators, by the market participants. Because believe me, moving from paper-based trading, and I used to have so many of those share certificates, to online, it destroyed an entire generation of brokers. That kind of change isn't easy, but India saw it, and it moved towards the system which is now best, probably among the best in the world. I think this progress will keep on continuing. I have made a mention about how annual reports have changed. So the move towards transparency, the move towards corporate governance, the move towards liquidity, the move towards for exchanges to become more believable. See, you don't have a choice, because if you don't do that, you won't have that pool of savings coming into the stock markets. You'll be stuck. The RBI has said that in the report that I've quoted. You're going to be stuck in real estate and gold. You go into retirement with that kind of asset, it's not going to look good on you. So I think the change has been fantastic. And I think that it's progressive and it should continue going forward also.
Yeah, no, I completely agree. I think the regulatory tailwinds on some of these things has been, quite phenomenal. The next chapter, Anupam, where you talk about the role of fintechs, I think that's fascinating because it's close to our heart as well.
Did you know that it was? I mean, I was really surprised when I read that it was Nandan in 2015. The guy called it. The guy just called it, and whatever he said then, everything has happened. Everything has happened, and I'm surprised. I mean, go on. Sorry, I'm just.
So I think UPI and Aadhaar have played a huge role, right? I think without UPI, payments wouldn't have been easy. And without Aadhaar, onboarding customers like tens of thousands, like you said, crore demat accounts, right? That's a lot of number that we've added. Question I want to hear from you, the answer, the feedback I want to hear from you is, in your assessment, what did they get right, and what did fintechs get right, and what did they get wrong in the last 2 years, where they saw like a crazy adoption of their products?
What they got right was the target audience. What they got right was the concept of UX. That was spot on, because that is a concept that my generation doesn't even know. You ask me for a lot of things, I'm still into the form filling and, I will do my own research kind of stuff. They got all of that so right. I mean, today, the user experience on a lot of fintech apps is just so smooth and so seamless that you kind of take it for granted. If you look at what Nitin Kamath has done with Zerodha, it's crazy. And you would know that, when you develop Fisdom, there is a certain level of smoothness that now is the standard. You've got to have all of this. That's what they got right. I think what they got, I wouldn't want to use the word wrong because it's a little bit dicey, was that almost all financial products still require a lot of handholding. So bringing the customer to the app is probably easy, but guiding him as to whether this investment or this product is appropriate for you or not is the longer haul. And, once you get someone to accept a UPI payment that happens in the matter of seconds, for the same guy to accept that his trade is not going through because the exchanges are jammed because there's a circuit happening, it's jarring. For someone like me, it's like, we've seen this stuff, this is how it works. But that's the part where I think, but then, what can you do out there? It's the whole, what's that called? Move fast, break things kind of thing. So if you didn't have that rush to create such great products, you wouldn't have this kind of UX today. So that's, I think, what they got right. And I think the trust part is still evolving. It's a work in progress.
Yeah, I mean, I want to ask you, that was my next question, because in the chapter, while you talk about the role of fintechs, I could sense there is a certain element of skepticism in terms of what they can do more. And is it because it's difficult to deliver personalized advice at scale in a trusted manner? Can you talk us through, what can they do better? Because one is UX, which is just making things available. Okay, I have 15,000 songs I can buy in like 30 seconds. The other one is making it more personalized. So these are the right opportunities for you, which are different from, let's say, your cousin. I want to hear more on that part. What can they do better, and where is the skepticism?
So I think it's interesting. The starting point needs to be a very comprehensive assessment of a person's risk return profile. Without that, there's no point going forward. And that is still evolving, because anyone who downloads the app, his first thing is, I want to find the next big thing. And you'll probably ask him 4 or 5 questions on getting a general risk return profile in place, and you'll force fit that into a certain asset allocation profile, which is fine. That's how the algo works. That's how the equation works. But as markets go up and down, to handle that person and then make him figure out. See, a lot. Take the example of mutual funds. Even today, almost all the conversations on mutual funds is return. Okay, these are the returns delivered in the past, and on that, this mutual fund scheme is good, bad, ugly, avoid. I mean, I don't think performance, as someone who runs a mutual fund product, you should know that, right? Is that the only criteria? I don't know. You've had one of the stalwarts of the Indian mutual fund industry retire. And what a legacy, man. What a legacy. It is just amazing. And to reduce all of that into best performing mutual fund and worst performing mutual fund, I don't know. So I think that's still a work in progress. Needs to be solved.
I agree. I think that's the problem that's worth solving, because I'll talk about subsequently in your chapter 5 and 6, where you talk about advice. Do we have enough capacity in terms of advisory, in terms of human advice, to be able to cater to millions and millions of customers? But I'll kind of hold that for a while. The next chapter, Anupam, you talk about the India dream, which is, we'll not talk about the growth opportunity in, we're all believers, which is why I'm an entrepreneur, which is why you are so optimistic in all your shows. And on the FIRE thing, I was just curious to know, financially independent, retiring early, or it very, very often. Like people don't know what is exactly financial independent. So 2 questions for you. Do people have when you speak to people, when you talk to your RIA that are interviewed, do people have an understanding of the definition of financial independent? And second, are you also seeing retiring early as a sort of a trend in India? Because this is a big deal in the US, as you talk about in the chapter as well.
It's a tricky topic. The Victory project was based on a very simple premise. Do what you love, become really good at it, and the market will pay you, and that's what you do for the rest of your life. Now, for a country where the average GDP is still $2,000 per person, a lot of people work because they need the money. Okay, and that's totally fine.
Cool.
And if you put it in that perspective, obviously you would want to retire early. Who would not? You have 10, 20, 30 years of working really hard. If you're lucky, maybe maybe in a job that you enjoy, and if you're not that lucky, you just do a job. So retiring early as a goal, yes, it's legitimate. The term FIRE, of course, FIRE came from the West, which is fine. Whatever rolls your boat, whatever rocks your boat. Is it a goal? A lot of conversations are happening on it, that there is something called FIRE and I want to retire early at 40. If that gets discipline in your finances, I am all for it. Okay, I'm all for it. Please, retire at 40. Hopefully, you'll figure out what to do for the next 40, 50, 60 years, as long as you plan the entire process. And that is what the book is about. Now, I'm not anyone to judge your retirement goals or your life or whatever. Personally, I would love to keep on working for literally till the last day that I die. Okay, but that might not be practical for everyone. Is FIRE a legit goal? Yes, it's a legit goal. It's a fantastic goal. For someone, if that helps you to plan your finances in a better way in your career, get good habits early, save in the right way, invest in the right way, invest for the long term. Please, go for it. Because when you do retire, you're going to need a reasonably large amount of money to take care of the rest of your life. So FIRE as a goal, it is there, it's real.
Are you seeing people saying they want to retire early And financially independent, obviously, one aspect of being financially independent is being debt free and having certain assets so that, and you take care of future expenses. But are you seeing people having clarity about this financial independence?
I think they have clarity at an Excel level. They don't have clarity at an emotional or a practical level. Okay, because life throws you a lot of curveballs. Believe me, life throws you a lot of curveballs.
Yeah.
So if if that Excel sheet, and the book in fact has a lot of Excel sheets in the last chapter, if that helps you to plan your money, then yes, the answer to your question is yes. I'm hearing a lot of conversations on Fire, a lot of online discussions, a lot of films, a lot of real life discussions where people are actually, a young 25-year-old who's starting off his career is saying that, yeah, dekho, I want to work like, 15, 20 years and that's it. And I'm like, okay, that's great for you. And if that, if that helps you to start a plan, then sure, go for it. That's, I think, what I'm seeing. The answer to your question is yes. A lot of people are going in for it, thinking about it. How they implement it is, of course, left to be seen. The FIRE movement itself, I think in the US was a meme stock or a post-COVID phenomenon. Let's see what happens out there, because there's a lot of stuff that lower interest rates allow that higher interest rates might not allow. So let's see.
Cool. I think the next two chapters, the 5 and 6, are the crux of the book. I would urge all the listeners and viewers to actually buy the book and read, particularly the chapter 6, which has lots of checklists. In terms of getting advice, which is a part of the chapter 5, you talk about DIY versus getting advice. One thing we are observing, particularly the millennials, people in the 20 to 35 years of age group, they want to do a lot of things on their own. They want to learn a lot even before they do. Even if they have an advisor, they want to verify themselves in terms of what's being made to offer them. Do you think that for those DIY type of people who want to do the financial planning on their end, let's say somebody who looks at your book and says, look, I've got this checklist, I'll do it on my own. Do you think there are sufficient resources out there to people to do it? And my second question is, if I were to do it on my own, like how much time do I need to spend per week to make sure that I am staying on course to my goals and I'm staying disciplined, etc.?
There are plenty of resources. That's so, a large part of the book is spent in describing the resources from screeners to forums. Okay, but remember that this is knowledge coming to you in a certain way. So how much of it is relevant to you, even I don't know. That's public information versus what an advisor gives you, which is, more face-to-face, one-on-one. So the first question, the answer is yes, that there are enough resources for you to sit down and plan your finances, from retirement calculators to sample financial plans to portfolio examples. There's stuff, even like a small case or your own app that offers a lot of this stuff in front of you. So a lot of resources out there, almost all of it, most of it at least is free.
Yeah.
Some are freemium, some are obviously at a premium, So, and there are a lot of platforms also, which are knowledge platforms that have a premium product. I'm subscribed to quite a few of them. Very, very useful. Mentioned in the book also. Yeah. So that's the first question. Yes, there are a lot of stuff out there. How much of time depends on what you want to do. Like I have written in the book very clearly that you have a life of your own. You've got a job of your own. You're better off spending time in honing your skills, developing your skills for your job that earns you money. Okay. Despite that, if you still want to spend a whole lot of time, tracking the markets and making a portfolio, there is no upper limit. I mean, literally every human being on this planet has got 24 hours in a day. It's not that Subbu has got 30 and I've got 20. You've got 24 hours in a day, I've got 24 hours in a day. You need to find that fine line somewhere. What are the responsibilities in your job, family, etc. If you can dedicate minimum of maybe half an hour to 1 hour per day, or you dedicate the weekends for that. A lot of the fund managers today, from the olden times, they talk a lot about this, how they would just, spend the weekends on deep thought. So structuring of time is actually the core, is become a skill now for everyone to have an idea of. So I'm not going to, lay down limits out here. It's open to every listener, every viewer to find their own level of comfort. I personally feel that your portfolio shouldn't be reviewed more than, and this is a view of a lot of the advisors that I spoke to in the book also, once in 3 months, once in 6 months. Just have a broad direction that things are going right and make broadly sensible decisions with your money. Don't blow up your credit card. Have health insurance. Have an emergency corpus. If required, have life insurance. So, and listen, once you've taken health insurance, you're going to probably spend a couple of hours in finding the right product. After that, you're sorted for a year.
True.
So a lot of these products don't really require a lot of time from your side. But when it comes to stuff like stocks, then the kind of what I see now, I'm like, you have a job, go and do it. What's the point in tracking what's happening in the market on a daily basis? Because that's not going to, when you're 65, you're retiring, it's not going to matter whether you beat Warren Buffett. What's going to matter is whether you got that retirement number that you wanted.
Yeah.
That's how I see it.
I agree. No, makes total sense, Anupam. Now, on the topic of RIAs, as you mentioned in the book, people need advice. And there are only 1,300 odd advisors registered with SEBI, and many of them are corporate, many of them are defunct. The question for you was: do you see this RIA population community increasing, exploding in the next few years? And second, more important question is this propensity to pay. As you know, in India, everybody, if you ask a question in a room of 3 people, there'll be 4 responses. Right? We are really good at offering advice for free, and we almost expect advice, willingness and propensity to pay for advice so that, they get what they want. I mean, how do you see this evolution in the next 3-4 years?
Yeah, I mean, the world of advice is messed up. So I don't blame anybody out there who's lost. Now, if I look at specifically at RIAs, this is a profession that's literally less than 10 years old.
Yeah,
work in progress. And I spoke to a lot of them when I was doing research for this book, and they were like, there's not even enough money to justify the kind of effort that we put in to build a base.
Yeah.
So the RIA model is still very much asset-based. If you're someone who goes there as a 25-year-old, they're not going to pay attention to you. And in my opinion, that's valid because their model is not that.
Yeah.
Okay, their model is the kind of effort that they put in, which is mandated by SEBI, by the way. Okay, that they need to have certain records, they need to have this, they need to have that, audits, compliance, blah, blah. That is the clientele that they serve, so which is fine. What will happen to RIAs? I think this is again a beginning. It's a work in progress. Hopefully, they will figure out how to make this more mass market. Okay, which then leaves the advice market open for the beginners and all. The beginners advice market is completely free. YouTube is the best advice market out there that you can get. No, that's a tough one. I think the mutual fund distributors, MFDs, I think they've done a fantastic job. The NJ Group and all that. These are people in the last 10, 20, 30 years who've actually, built a base and they've survived it. When SEBI moved from regular to direct, imagine your entire business model becoming, is just vanishing overnight. But they still survived. A lot of the ones who have grown bigger have figured that I cannot keep pushing products on which I'm getting a high commission on the mutual fund. At some point of time now, the market has become democratic. My underperformance or my whatever will be spotted and the customer will come to me. And then once that relationship goes, it's gone. He's not going to come back to me. So a lot of that advice is also gradually changing. Products are changing. Smart beta, passive funds, all of that. It just offers a simple way without thinking too much for investors to allocate their money. So I think the advisory market is growing. It's growing in a great way. Some of it, obviously, there are excesses about people having their YouTube channels because they are not regulated, right? Yeah. They are not beholden to the same rules and compliances that SEBI has for RIAs. These guys can say whatever they want and completely enjoy themselves. No one's going to go after them.
Yeah. I think, my quick reaction to one of the reasons why I think the market still has large number of successful players on the regular plan, MFDs, is to me the big change was this whole move from everything upfront to everything trail. So that just made MFDs all the more, think in the interest of the clients, because the client doesn't stay, the client doesn't make money, you don't make money. I think that alignment of interest became much better. Of course, there is still a principal agency problem, intra funds, fund A versus fund B. But the bottom line is, you make money, the customer makes money in the long run. I think that was a intervention from SEBI that 2-3 years ago made a dramatic change. Is something that I hear from customers who still use MFD, saying that, hey, listen, look, if I make money, he makes money, I'm okay with that.
I'll in fact throw that question to you, Subbu. It's the same question back at you. Where do you think this is at?
See, I think the market is getting mature. My sense is the the ignorance quotient, if you will, where people did not know the existence of direct plans or the difference between regular and direct, right? I think it has reduced dramatically. So wherever people are making, in my view, people are making conscious choice. They know this is what it is, what it is. What I've seen is for advice, particularly for direct plans, I think there's still a question here. Listen, look, payments typically upfront, and what is being sold or what is being offered is hope of a promise of a better future, whereas cost is now, and that people are little unsure about. And whereas in the case of an MFD, that cost is unseen and not like it's an unseen cost. Yeah, look, if I make money, he makes money, rather than look, I'm having to pay, let's say, 20,000 rupees or 1 lakh rupees. So I think there's a certain amount of equilibrium that we are hitting in the market right now. But I completely agree with you that for a certain category of customers and above, let's say 1 crore, 2 crore, 5 crore and above, probably the market will shift towards advisory in the next few years. We just need more. We need to add a couple of zeros to this 30 that we have in terms of advisors.
Yeah, I agree with that.
Yeah. And I think the next chapter, I wouldn't talk about that because that's something that people should buy and see. There are lots of calculators, lots of checklists. I would encourage everybody, particularly the people who want to do it themselves, to read this and then do it rather than follow some YouTube advisor. A few other questions, Anupam, other than the book. How is financial planning, in your view, based on the 6 interviews that you've done, of course, your own experience, different for women? Because I keep saying this, a lot of financial services in India is very, very male-centric. I'll give you an example. If you look at any insurance advertisement, or something happening to him. So if you look at a mutual fund ad, this bank ads, so they're all basically men-centric. It's almost understated, deep state that, financial decisions are male-dominated. So how, in your experience, how should women look at this financial planning?
I really, what a great point. And Paisa Vaisa, I've been struggling to do this and, have at least equal representation or at least do something out there. And this year, thankfully, I've had a lot of very, very interesting guests from women and personal finance. I had 2 or 3 episodes. Shinjini at My Salt app. I had Sari at Shiro's, and a whole lot of stuff that I'm doing out there, trying my best to to correct what is most definitely a problem. In the book also, I tried my level best. There is Dilshad. She's literally the first RIA that starts the book. True. And then there is Shalini. So both of them have spoken at length, and the kind of insights that I got from them were head explode kind of stuff. It is different. There are a lot of things that are very, very different for women that the financial industry needs to get sensitized to. Now, obviously, almost all the products will work the same for a man and they'll work the same for a woman. There's no doubt about that. I'm talking about the nuances out here. Like Dilshad told me about how she made it mandatory that whenever a man comes in, you have to get your wife. And that was not the case 10 years ago. Right? 10 years ago, the husband would tell the wife, listen, you're not going to get this any which way, so why do you want to come? And the wife would be like, yeah, chill out about it. Money is not my area, so you only go. Today, they insist. That's the first thing. Second thing that both of them told me was about life stages in women, and the way it hits their money is crazy. I mean, as a man, I would not even understand this. Divorce, okay? Widow, parent, single parent, and all of this stuff, it just hits money in such a way. One example is how the attitude towards life changes. Okay, so I think Shalini told me about this, or Dilshad, that when a woman gets a divorce, the way that she looks at money, at investments, at rate of returns is completely different. She could see that change in her clients. But that's one thing that I could never get. It's just a nuance that came to me through the interviews. The second was, she said that people have this impression that homemakers, okay, or in my generation, you used to call them housewives. They know nothing about money. And she said that is such bullshit. Some of the most practical ideas about money would come from them. The way that they look at money, spending it, saving it, it all, so there is a need for all of this. I made a very, very tiny beginning on this front, and I hope that, people take it forward from here.
No, I think some of the sections you specifically speak about financial planning for women in some of the chapters, which I think is very welcome, Anupam. I was also curious to hear about things that did not make it to the book. What were things that let's say 3 things that you wanted to say in the book, but you did not say things
that did not make it in the book were influencers. Never responded to me. I thought, let me give them a chance to, I've spoken to 6 RIAs who are real world people, and I've mentioned a lot about how YouTube and, social media has so much of content on personal finance. Let me at least, call these influencers and say, hey, I'm writing a book. Do you mind? You could spend half an hour, 1 hour of your time. None of them responded. From one, I got a response saying that we are too busy. Honestly, we don't believe in books and stuff like that. I reached out to an online forum and they were like, yes, we are all for it. They just vanished. So that's one part that I was hoping that I would get somebody from their side, but that never happened.
Okay.
Second was, so this book actually originally started as an idea to interview fund managers.
Oh, okay.
That never made it because, I got advice from a lot of people that listen, fund managers can only talk one thing and one thing only, which is kya lagta hai? So why you want to do that? I was like, okay, fine. Which is why I chose RIA. So that's the second thing that didn't make it. And I think the third, that's it. I can only think of these two. Otherwise, the vision that I had, I don't think there's a number 3 out there. These two.
I think the book is comprehensive in itself.
It's short also. So it's short. It's a very small book. I wanted to ensure, I think it was Morgan Housel who had tweeted quite a while ago that a lot of books need to be many chapters and smaller chapters. So I thought, let me not go down that road of writing a 300-pager or something. And the Penguin guys are also like, maybe you want to increase the word count out here. And I was like, I'm already... So yeah, there you go.
Oh, but the book is very accessible. It's very easily readable.
Thank you.
That's what makes it, that's the best part of the book. Anyone can pick up the book and say, become smarter at the end of the book. A few questions, Anupam.
Sure.
On some of the questions that you asked, the RIAs that you interviewed, would be good to have your perspective on how should someone think about it. These are very important questions people ask, which is rent versus buy.
Rent versus buy is something that I've had a very strong opinion on, but, strong opinion actually is an opinion, I would say. I just think buy it if you can afford it. A home will never come cheap in India. I can't think of, so if it doesn't come cheap, then you have to become rich. That's just one way of looking at it, right? Because whatever you want is never, ever, ever going to be of that. I think LTVs are at 4 or 5 times right now. So who in his right mind would, pledge 5 years of his salary to buy a house? It's a tough decision. Rent away, just rent away till you find a level of comfort. I know of so many people in the stock markets who are very hardcore believers in renting. They're like, we just do not, it makes no sense to buy a house. And there are some who say, I don't want I just want my own place. To me, home is a place in a building, in a city, in a country. That's it. So it's a very, very, very individual decision. It's not something that can be, and I think a lot of the advisors have also said the same thing. Yeah. If you can make a plan for it and if you can keep it within control, then please do buy a house if you think that you need it. If you don't, rent away. 7-8% interest rates, 2% yield, it's financially, so it's a no-brainer.
Yeah, I think two of the advisors that you interviewed make this point about the emotional aspect of rent versus buy.
It is only emotional. I don't think that rent versus buy can be captured on an Excel file as much as everybody wants to.
Some people want to buy a house because they want to feel like this is my space. At the same time, I've seen people who don't buy a house because they like the impermanence of living. Like I'm one of them. Look, I don't have a house because I just like this whole concept of not being permanent in one place. But so I think the book makes the point very, very well. Look, rent versus buy is not an intellectual decision. It's
and at the end of the day, honestly, and I think as a startup founder, you would know this more than me, that once you make a nice pot of money, you will not say that I'll put 10 crores into ITC. You say let me buy that damn, row house in Balerghatta or wherever and just fulfill. It's like a tick mark.
Yeah.
So that game is slightly rigged mentally also.
True. FD versus debt mutual funds.
FDs are, I invest in FDs. I'll be upfront in saying that I'm a big fan of them because they are literally the only investment product out there that have an official rate of return, and they guarantee you return of capital and return on capital. There is no product, absolutely no product that gives you that. Okay. A lot of advisors are of the other view. I think Harsh has called it a lazy product.
Yeah.
A lot of them believe that it's, it doesn't even beat inflation. I think FDs do serve a purpose. If you think that, for me, for example, I just believe in a lot of bucketing. So when it comes to my own money, I know that when I keep something parked in an FD for a certain purpose, then I don't have to think about it. And debt funds are awesome, no doubt. But we know what's happened in the last couple of years.
Yeah.
And it's not been the best possible outcome for a lot of people who went in with the belief that a certain category of debt funds, at least your capital is guaranteed. That you might not make 8%, you might make 7%. Now imagine that person doesn't have access to his funds.
Yeah.
That is not, that can never ever, of course it can still happen in an FD. I'm not saying that it can't happen in an FD, but in an FD also, if you do certain checks and balances, an SBI FD is pretty much what? Sovereign guaranteed, I think. So you're not going to go wrong out there. Yeah. So yes, they do solve a purpose. You need to decide whether that purpose is what you want or not.
Yeah. So interesting, because by and large, I think 5 out of 6 advisors probably said FDs, debt mutual funds.
Avoid. Yeah.
Like, if you get the selection right, then debt mutual funds are probably better. And stock versus mutual funds.
Stocks versus mutual fund is also, I personally, I prefer mutual funds again because I don't have the kind of time to set up portfolios and think of what stocks to buy and what to do. Big fan of mutual funds. I think they're as good as an FMCG product. They are sticker based. You know what you're buying. The fund manager is really not that important. I think now the market is also mature to know that the institution endures more than the fund manager. And I think that if you stay with the mutual fund long enough and keep on doing it every 3 to 5 years, you'll probably, you might not beat a stock or a set of stocks or whatever it is. But if you have a certain targeted rate of return, selection in mutual funds can help you achieve that. Again, the same point, right? Do you want to beat the best guy on the street or do you want a certain rate of return?
Yeah. And active versus passive, active fund managers versus...
So I liked a lot of the advice that came in from RIAs who spoke about a core and satellite approach, where the core is passive and satellite is active. I think that's basically like saying that 80% should be active and 20% play around, find the right active mode, and that just adds to that. But look at passive, look at the depth that's come in. Depth has come in, liquidity hasn't. A lot of the new smart beta products are still not that liquid for you to get a good NAV, and even so that is still developing. But other than that, I think, passives should definitely form a large part for investors who don't have the wherewithal to sit and sift through active stuff.
Yeah. I think other than the benchmark indices, I think the liquidity is low and hence the tracking errors seem to be slightly higher than what one would expect. Yeah. So you would see, this index has made more money, but my, index fund hasn't done well. So because of international investing, I think you asked this question with a lot of advisors. I'll probably ask a slightly more nuanced question on international investing. So I think one is dollar diversification and all of that. The second one is investing in these high-profile, high-flying FANG stocks. One thing that I've struggled with customers at large when it comes to international investing is the cultural and economic understanding of US as a market is not deep enough that the only stocks that they can buy if they go to international investing is those 4 or 5 stocks. Beyond that, there is just no stock. There are, just like India, US also like thousands of stocks that they can buy on NASDAQ and Dow and so on and so forth. But people eventually go and buy those 5 stocks. And I keep telling, look, if those are the 5 stocks that you want to buy, you might as well buy an ETF that mirrors or NASDAQ ETF. What's your view on international investing?
I completely agree with that approach. If you have to do it, then please go through an index fund or an ETF, depending on which one suits you better. I think an index fund probably is a little bit more simpler than an ETF. Direct stocks, honestly, you do it for the thrill of it, then that's fine. But I just don't see any point out there. You want to do something new, like people like to buy new mobile phones every year or whatever, then that's fine. But I personally, with my own money, I do not invest internationally at all because I don't understand that stuff. And I still feel that I'm more or less more comfortable. Also, the tax regime, right? All international products, I think they're treated on par with debt mutual funds, which is that you need to hold them for 3 years and stuff like that. I think I'm not really sure about that, but I just feel more comfortable buying stuff that I understand here in India. I have dabbled a little bit in international stuff, but I honestly, I don't understand the stuff which is why I don't buy it. But the RIAs in my book have been very clear that they definitely want a 10% kind of allocation towards international assets. Regulated products, by the way, crypto does not count out here. Do not talk about crypto. They're talking about regulated products in that 10%. And I think their logic is also, it helps reduce volatility, it helps diversify, it helps this, it helps that. So there is definitely a case for international investing. How you choose it, I think you need to figure that out.
Understood. Final question, you mentioned crypto.
Crypto, yeah.
Right. So maybe I'll ask a slightly nuanced question on crypto. During the course of this book writing, Anupam, as you were interviewing advisors, did the outlook on crypto or feedback on crypto change, or have you had consistent feedback on crypto?
Oh, so the RIAs can't recommend because it's not regulated. So one is there is a regulatory thing, which is why none of them could even have an opinion on that. Because they're like, even if we want to, we don't anyway, because SEBI doesn't allow us to give any advice on unregulated products. Crypto, honestly, back in 2017 or 18, I think I'd opened an account with some platform and I was like, well, let's try it. What's doing? I couldn't understand anything, man. I'm sorry. I'm too old for this stuff. It's like the meme goes, right? I'm too old for this shit. I have no idea. I have no idea what crypto is about. And honestly, if it's not regulated, it does not work for me.
Yeah.
To know that all my money ultimately will go into a pen drive and I have to remember that passwords. I'm the old person. I just need to call someone and say, hey, buy this, hey, sell that, and that's it. So no, and no. Those are the three answers to crypto.
I'll tell you a joke on Twitter. Yesterday, you would have seen somebody tweeted, if you have a diamond and if you convert the diamond into an NFT, even if you lose the diamond, the NFT is still as valuable as a diamond. So somebody replied back saying, if somebody dies, that person is still alive as long as you have the birth certificate.
I saw that. I think that was Parik Patel, and Parik Patel is
awesome. A hilarious take on this whole, esoteric world of, crypto. That's helpful perspective.
Makes no sense to me, man. Makes no sense to me. And
so finally, what's next for you, Anupam?
I have started my second book already. This time around, it's, thankfully it's not on personal finance. The tricky topic. This one is a biography of someone. So, and there's a lot of history involved in that. So I'm really looking forward, because I just find India's corporate history fascinating, and it's not been told in a major way. Nowadays, entrepreneurism, has its different take and all that. And I'm like, just go back 100 years and you see the kind of lives that the capitalists or the industrialists or the entrepreneurs lived then. It's really different. So that's what's next. Paisa Vaisa continues, of course. I'm just very, very humbled and really thankful to everybody who listens to it out there, gives it the love that it does. 2 million downloads, 350 plus episodes, I think 100, 200 guests going on its own. Ventured into a new podcast called The Last Brand Standing with Ambi. So there are 2 podcasts there, and there is 1 book. That's what the future is about.
No, that's so awesome to hear. And look forward to that book. Any final comments for our audience about the book, or anything that you would like to say?
Yeah, just have a plan. Those are the 3 words. I mean, that's all that I really firmly believe, that this country is going to change in the future, and your investments will also, they'll have their ups and downs, but just have a plan. Think through your money. And I hope that my book helps you to do that. And that's it. Yeah. Just 3 words. Have a plan. That's it. Nothing else.
So absolutely. The book does help everyone to have a plan. Thanks, Anupam. This was...
Thanks, Subbu. Yeah. Thanks for having me here. And I hope to see you on Paisa Vaisa again. Your turn to come on my show. Yeah?
Absolutely. Thank you. Thanks.
Bye. Bye.